All right. Good morning or good afternoon, traders. Today is Friday, December 5th, 2025. This is You've Got Options for Income Navigator. We're going to go over positions that I have on. We'll look at some risk graphs. We'll look at some potential adjustments. I have made a number of adjustments so far today. Closed a couple of short SPY naked puts right around their targets. And if we are looking at this spreadsheet here, as you can see in December so far, right, we're 5 days in, I've only entered two new trades. One was on 12.4, one was on 12.5. And since end of last week, which was the 28th, right? There's been only one, two, three, four trades came off in the last couple of days. A couple of trades came off in the middle of last week, right before Thanksgiving. But so far, I said earlier today that so far trades that came off in December, as you can see, these trades were put on in, one was in November, and few others were in towards the end of October, right? So between 10:27 and 11:05, so within about a week, these trades were put on, and they all came off at around the same time, right? So in the last 2 days, we had four trades come off. They are around their targets for a total of about $1,300. And when I said that, don't overcomplicate simple process. If you have a good, tight trading plan with a clear entry, any adjustments? If yes, then what it is. If no, what is your stop? And let the probabilities play out. Let your trades either hit your exits at a profit target, hopefully not at a stop loss, but if that's the case, then it is what it is. Or if you're planning on making adjustments, you know when and what to do. If everything goes well, you don't need to worry about the profits. They will take care of themselves. We kind of set tight for about 29, 34, 37, 39 days, right? So what's that? An average of about 35 days. And in the 35 days, this system has generated enough profit to cover over a year worth of access to our community, right? So everything else now becomes a gravy. There's a ton of great content. There's a ton of great trade ideas, questions, answers, all sorts of different strategies being looked at. Ton of members post their own trades that could lead to potentially generating some great ideas as well as content. So there's really no shortage of ideas out there, but do not try to drink from a fire hose. As Tom always says, if you try to do everything, you're going to fail at everything, right? Find what works for you. Understand, what is happening. See if whatever is happening could potentially be applied to your trading goals, to your trading plan. And if that works, start small and work on scaling your trading business, right? So in the last couple of days, we took off a couple of trades. We put on a couple of trades. And if we look at, I'm not sure if I like this color scheme here. Maybe I need to change this. I'm not liking this. But as you can see, I started tracking this variation of this trade from about end of May. Since then, we had 71 trades put on, 67 trades came off. We have 4 trades that are currently open. I track total notional value of trades that are open. I also look at what is my notional leverage? How does the total notional value compare to net lick in this account? Right. So right now I'm at about 1.24, which is not super aggressive. It's kind of halfway. For me, right, in my opinion, anything around 3 is kind of like that line in the sand. Anything beyond 3, you're getting very aggressive. Even though it doesn't take a ton of margin in a portfolio margin account to put these naked puts in SPY, if you put too many trades and they all hit a max loss or max allowable loss per trade, whatever that may be, if I'm tracking my trades and my loss or my stop is a 2x credit, right? I'm also tracking what my stop loss is. For example, trade that I put on today, I shorted a February 27th, 635 put with 84 days for $6.72. Notional value here is, right, strike is 635. So notional is $63,500. And you can see my profit target is 50% of credit collected. So I'm going to try to get out for around a 336 debit. If I am going to stop out, my stop is a $20.16 debit, which will be equivalent to 2x credit loss. And in dollar terms, my loss, if I stop out of this trade at 2016, my loss is going to be $1,344. So I look at what is my stop loss in dollar terms, right? So I see that if I have 4 tranches on, and if they all get stopped out, this will be a total loss of about $5,404. And then I look at how does this loss of $5,400 compare to my net lick, right? This tells me that if that would be the case, if I stop out of all 4 trades that are on right now, my loss would be about 2.65% of my net lick, right? And these numbers are not the secret numbers. This is not, I'm not telling you that these numbers that will work for you. You need to know what works for you and what doesn't, right? Because sometimes people hear that, oh, if I put on the trade, I'm going to risk only 2% of my net lick. That sounds great. I see everybody else doing it. But if your account is in the millions and you wouldn't be able to stomach a $30,000 loss, clearly, right, 2% means absolutely nothing. You also want to know what this loss would look like in dollar terms. And then again, you have to be okay with potentially, right? We don't trade to take losses, but we know that if everything goes sideways or if everything goes against us, right? What will our loss look like in dollar terms? And you have to be okay with that idea. If you're not okay, that doesn't mean that you're in the wrong business. That means that you haven't scaled to be trading on this level, right? You need to keep your size even smaller. And then eventually, right? Eventually, when you start out really small and then you gradually increase your size, right? Looking at potentially taking a $5,000 loss on a $200,000 account isn't going to sound like a big deal, right? But if you're traded in a, maybe $20,000 account where, a couple of $100 loss felt like it was okay, and now you're looking at a $5,000 loss, in a $200,000 account, if these numbers sound like a lot, it's not. You're just not there yet, right? So, and I always say that you need to focus on starting out small and work towards scaling the business. Like you can't go from a $25,000 account to a $3 million account overnight and be totally okay with the risk in a $3 million account, not because it's wrong, just because you're not used to working with those kind of numbers, right? So, and then I also look at total P&L. This is from when I started to track this variation of this trade. There have been no losses thus far. Total P&L is at about $18,277. And then just to get a rough idea, right, I looked at if we continue at this pace over the course of 365 days, what is the return on not just risk, but on overall account, right? So this account was about, I think that if I back out the realized profits, I think this account started at about 150. That's what the minimum requirement for portfolio margin with Thinkorswim or with Schwab is what they are now. And if I back out, I think I added either 30 or some odd dollars because I was looking to take assignment on a few other positions. So here we are. If we are to continue at this pace, I'm pretty sure at some point we will have some losses. So this isn't a guarantee in any way, shape, or form. But if we continue on this path, we could potentially realize about an 18% return on overall account, right? And if you want to look at return on risk, right, or return on margin, portfolio margin requires very little compared to total notional value, right? So it's kind of a dangerous game. But if we are going to use return on margin for SPY, the four tranches that I have on right now, I'm going to take a look at what is the portfolio margin requirement for the four tranches that I have on, and that is currently sitting at 20,000, 19,000 and change, right? So I'm currently holding $253,000 worth of risk, right, with about $20,000 that's actually being tied up with the broker. So you get almost 10-to-1 leverage with this strategy. But if we wanted to kind of look at total return on cash, right, assuming that if this account was maybe a 170, right? So on 170, it's about 18% or something like that, right? And this trade really doesn't take any management whatsoever, right? I'm not looking to adjust. I'm just looking to get out at my profit target. As far as stops go, and this is something I really want to just briefly touch on, and we talk about this before, and we're going to continue to talk about this, that if I was to stop out, right, that's one thing. That is, if I'm, maybe stretched too thin, too many things going on. If I know I may not be around to make adjustments or roll trades or do anything else, I just want to get out and kind of, sit on the sidelines for however long, right? So I'll use a stop. Yes. Also, if I was to get assigned on any of these short puts, my next step, which would be kind of part of the wheel strategy, if you will, the next logical step is after you get assigned, you go out and you sell a covered call against your long stock position, and you are potentially looking to get called away to hopefully realize a capital gain, right? That completes the wheel cycle. Now, we talk about the wheel and the covered call, and if we stop here for a second and think about a covered call, which is long stock short call, is equivalent to being short and in the money put, right? So why would I take an assignment on the put that is going in the money only to sell a covered call and put myself back into a position that has exact same risk graph as a covered call? In other words, instead of getting assigned to sell a call against my long stock position, I would just consider dealing with an in the money put, because if you want to write this down, that would be a good idea. An in the money short put, naked put, in the money short naked put equals to a out of the money covered call trade, right? They both have identical risk graphs, right? So my plan here is either to stop out and not have to deal with rolling in the money options. I would use a stop loss, and I have before. Or if I'm not stopping out, if I am willing to take an assignment and then sell covered calls against it, instead of doing all that, right, I would consider just dealing with short in the money naked puts. The only difference between a long stock and the short out of the money call versus short in the money naked put is that with a short naked in the money put, we do not get any distributions, such as dividends, any special one-time payments, and we have no voting rights. Otherwise, as far as risk graph goes, the two trades are identical. So that's why I don't think I'm going to consider getting assigned on short SPY puts. One of the reasons is because what am I missing? I'm going to miss out on the dividend yield. SPY current yield is 1.07%, right? So I'm missing out on that 1.07% dividend yield potentially, right, by not taking the shares. But what I can do, instead of having to tie it up, for example, if I was to get assigned on this 635 put, right, that I shorted today, which has a notional value of $63,500. If I was to get assigned, I have to pay someone $63,500 for those 100 shares that get assigned to me. Even though a lot of that buying power will be returned back to me from my broker, right? They'll only require me to keep a small fraction of this 63,000, but I have to deliver $63,500 worth of settled cash and sweep vehicle, as Schwab would call it. So what I would do instead, I would roll an in-the-money put, which does not take any settled cash. It only takes buying power. And I would use, maybe $55,000 worth of settled cash. I would put that into treasury bills that pay more than 1.07%. Right? I think T-bills right now, 4-week T-bills are somewhere around 3.9% or something like that. Right? So I'm not really missing out on anything by not taking assignment on SPY and giving up that dividend yield of 1.07%. I would take the settled cash, buy treasury bills, get a higher yield, and then with treasury bills, I get 99% of buying power back, and I would use a small fraction of that buying power that I get back from my broker to just continue to roll an in-the-money short put in SPY. Right? Hopefully this makes sense. If not, we can talk about this more. I think that there is a training in the works around this topic where we can really dive in and spend not just a couple of minutes, but we can talk more in depth about how to do replacements, between covered calls, replace that with in the money short puts, how to replace the yield that we may be missing out by not taking assignment. And I think that's going to be very interesting, and hopefully you guys get to participate in those discussions. Any questions about this short SPY? And I'm going to look at, there's another variation that I'm currently doing, and I'm not really seeing a whole lot of edge. But it's too early to tell because there's still too little data that I have collected. I'm going to look at some questions, guys. If you have questions here on Zoom, great. If not, we'll keep on moving forward. Noon says, what triggers the entry in this strategy? So with the short SPY put campaign, this kind of evolved from a Monday, Wednesday, Thursday campaign where I would put on, 3 short puts every week. Except here, we are limited by, or we are kind of under control of notional leverage and how total notional value of open positions relate to total net lick, right? Like we don't want to go 10x on notional leverage. And if we get some kind of a, oh crap moment, right, and we're forced to stop out of half of our positions, the total max allowable loss will be equivalent to a 40% haircut in our account because we had too many positions on because they take up so little buying power to put them on in the first place, right? So in order to stay responsible, we're using notional leverage multiple, right? And if we keep that around 3 as kind of a line in the sand, look, 3 may be, too little for some who are willing to take on more leverage, more risk. Maybe you feel great about the market. Maybe we are coming out of a 17% correction where you expect the market to grind higher over the next 6 to 9 months, and you are willing to step on the gas a little bit and increase your leverage. That's totally fine too, right? There's a lot of proprietary there are proprietary steps that you can take, right? You have to decide when you are willing to get a little more aggressive, or maybe if we are, running on fumes and market just feels heavy, there's some indication that maybe the momentum is kind of running out and market is potentially rolling over. You definitely don't want to, plow and increase your leverage drastically, because what's going to happen if the market does pull back, right? You might just end up with a ton of in the money puts, which is totally fine, but you have to be ready for that, right? Or if you're saying, you know what, I just can't deal with this right now, or, for whatever reason, I need to stop out, and you have, something like 25 tranches on with only a couple $100,000 in the account. You say, out of those 25 tranches that I have on, I'm going to, take off 15 or maybe 17 or all 20 and leave 5 on. Your total max allowable loss will be such high dollar amount that it's going to take a big chunk of your net lick, and it's just going to make it that much harder to recover from. Right. So to answer your question, what triggers the entry? We enter the trade every Monday, every Wednesday, every Friday, only if we have the room to do it. What tells us about if or not we have the room to do it? We'll look at the leverage. Right. I also included the VIX reading, which technically should be updating somewhat in real time, or according to Google Finance. So, when the VIX is in the 15, and change, do you want it to be at 3x leverage? Maybe not, right? Why wouldn't you want to do that? Well, what's going to happen if VIX is at 27, right? When VIX is at 27, your buying power is going to dry up, right? You are not going to add any more trades at that point, right? So you're potentially missing out on some juicy premiums, if you will, right? I'm not saying that I don't think that the VIX should dictate your amount of leverage, even though you can use, when the VIX is low, how much premium do you want to sell? For me personally, I would prefer to do trades when VIX is relatively low, right? The market is stable. VIX is a forward-looking vehicle, right? Looks into demand for S&P options 30 days into the future. So right now, with the VIX at 15, right, the market is not anticipating a day-to-day movement greater than 1%. Right? So the market's pretty calm. And you can say, well, the VIX is too low. It's not enough juice in these options. I'm not doing it. Fine. But the market can stay calm for 6 months. I'm not saying it will or it won't. I don't know that. But if it does, if you're waiting for the VIX to be at 27 plus to go to work, what if VIX goes 27 plus only twice in the next year? You will have done no trades, right? So again, I'm not making the case that you need to trade full size at all times, but you kind of want to understand, where do you make the most profit? Or where is the VIX when you enjoy the markets, right? Because we can go for long periods of time with volatility being relatively low, right? And the profits feel like they come easy, right? Everybody is, complacent, and this could last a while. And if you're not putting on any trades, if you have not done any trades because the VIX was too low, you're sitting out. And then at some point you might get, the FOMO, where you will force yourself to put on trades at the worst time possible, right? Or if you're just waiting for the VIX to be in the high 20s to start to allocate capital when, the market is swinging, at VIX at 27, right? At VIX at 27, we have an implied 1-day move of around 1.7%. Do you enjoy trading when the market swings up or down 2% day to day? If that's your jam, then go ahead and do it, right? That's fine. Nothing wrong with that. If you enjoy doing your trades when the markets are calm and are not freaking out about anything from a day to day, then, VIX between 15, 16, 17 is a good time to do income trades. So we're going to put on trades at all times as long as we have the room to do it. And then it's just discretionary. It's up to you, right? How much leverage you want to have at any time. Maybe 2x is too much. Maybe 3x is not enough. I don't know what your situation is, right? Because if you throw on, like right now, I'm at 1.25x leverage. If what hits the fan and I stop out of all my trades, I'm out, $5,500. If I'm okay with it, that's fine. If that's already kind of like, making me uncomfortable, then I cannot go too much higher than 1.25x leverage to my net lick, right? So you have to know you. But otherwise, the game is always on. I just wasn't able to, not that I wasn't able to, I just didn't want to deal with putting on new trades while I'm not necessarily able to attend or at least check in once a day. I was away for a couple of days with my family, and therefore it's totally fine to take a week, a few days from putting on new trades. But now I know that I have a bunch of buying power available. I'm not going to go all in as if I'm chasing something. I'm just going to continue to do business because there are going to be times, such as, for the big part of November, right? Big part of November, if we look at the November had a good amount of exits, but what I want you to pay attention here, right? This spreadsheet has a ton of information. We just need to know what we're looking for. So in November, I was closing trades, right? 11.5, 11.10, 11.11, right? There was nothing from 11.11 to 11.26. So for a couple of weeks, there were no exits. Why? Because remember what happened in November, right? We had a kind of a dip, volatility spiked, right? My trades weren't coming off because they were nowhere near their profit targets. As a matter of fact, at one point, all trades were negative, right? They were showing unrealized losses. And then what I also want you to look at is look at the entries, right? We had October, October, October. We had November 14, November 5, November 12th, November 26th, right? So if we were to do trades Monday, Wednesday, Friday, that's 3 a week. Let's assume there are 4 weeks in November. We should have had 12, but there were only 1, 2, 3, 4 entries in November. Why? Because, well, nothing was coming off, right? So I was sitting at over 3x notional leverage. I had the buying power to do it, but the buying power doesn't tell me to add more trades. It's about how much leverage you want to have on, right? Because if you feel like November was bad, right? Things can go from bad to worse to horrible. We don't know where and how the market's going to go forward, right? So you identify how much leverage you're willing to take. And if you don't have the room to do it, you're just going to have to wait for some things to come off. And then when things start to come off pretty quick, you can see that we had closing trades in from November 26th, which is end of the month, right? It's right before Thanksgiving. Volatility started to come in, right? The market's kind of, settled in a little bit. Volatility contracted. You can see we had 6 Six trades closed for a total of, $375,000 worth of notional. All right. So you kind of have to understand where you are in this trade. And this is one of, and I'm going to say this for the rest of time, however long it is, right? That it's not me telling you that you should put on the trade every Monday, Wednesday, or every Tuesday, Thursday, and whatever. It's the general idea. You can put them on as often as you want, right? And you have to understand that it's not just wait for one trade to come off until you put the next trade on. Yes, that's also a general idea, is that when things come off, new things come on. But what's the lever here, right? What controls the whole thing? It's the leverage, right? You can do this trade for a long time, taking on way too much leverage without realizing it, and get rewarded for a long period of time. And then when you get the reset, you get something like I don't know, August of last year, which, there is a sheet. Right. This is the older version of the same trade. Right. You can get, look at all these. So this is the P&L graph, P&L column. Sorry. Right. We had some losses going back to 2022, right? The beginning of the year of 2022. And then 2022 was a down year. Look at the stretch of winning trades. Right. So this is a pretty resilient strategy, which could be very easy to fall for. Like, oh, I can just go all in. I'm going to, take on excessive risk, and I'm going to try to make up for it with that excessive risk. I'm going to try to squeeze, 30, 40% annual return on account. And that's wrong, because there are going to be times, look at this. We went green in this trade from 2022, from top of 2022 into July of 2024. All right. So this is a very resilient, very easy trade to manage. But then there are going to be times, right? This is August, early August of 2024. And you can see before the August 5th, right? This is what everybody talks about, August 5th, but before August 5th, there were already trades that were hitting, right? Losses. They were hitting around 3x credit losses. And these were done with automatic stops, right? I was not willing to take assignment. Did not want to deal with in the money puts, right? So you put your stops in, and then yes, stops. Once you put the stop in, if you're not willing to deal with it, right? If you put the stop in, there is a chance that you get stopped out. And if you do, you can see it's not stopped out on one trade, right? I got stopped out on pretty much all of the trades that I had at the time. Right? There were losses, to the tune of about $3,700. And it all happened literally within just 2 days or so. Right? But if we didn't have the lever, or if we didn't have that notional leverage multiple, right? That's what we use to understand how much notional leverage we're taking on. If we didn't have, I don't know, I think I had at this point, I think I had 8 stops hit, 9 stops hit. And then I had a couple of trades left over where, once the market kind of, fell out of bed, I said, you know what, I'm going to deal with the remaining. I think I might have had like 4 or 5 tranches that you can see here, 1, 2, 3, 4, right? So 8:30 when the market bounced, right? These trades closed up really quick. So I think there were either 4 or 5 tranches that were left over, right? I was willing to take those, either assignment or deal with in the money naked puts. But the market bounced fast and these trades closed out. So maybe I had 9 stops and 4 leftover trades. So I had 13 tranches on, and I still wasn't using all of my buying power, right? I was looking at the notional leverage as my guide to tell me how many tranches I could hold. Sure, there were times where I would hold as many as 20 tranches in this trade, right? And leverage was very high. So you kind of want to understand the context. But for the most part, right, this trade is very easy to get fooled by because portfolio margin takes up very little margin to put this trade on. You have all this buying power. You get into this, oh my God, my buying power is just sitting there doing nothing. I need to push more chips in. Next thing you know, you're holding 30 tranches in an account that can't handle that kind of risk. The market rolls on you. You have to stop. And before you know it, right, all your stops will be equal to, you know, 17 or 25% of your overall account. And if you don't think that it's a big deal to lose 25% of your account with a strategy like this, look at how slow this thing moves, right? These are one lots. If you make 100 a pop, how many trades will it take? How many winners do you need, right, in order to make up that 25% haircut you just took? So don't put yourself in that position. It's not because you were doing something wrong. If you've ever find yourself in that position, it's just because you took on way too much risk. You bit way too much than you can chew. And that's the problem. And in order to stop yourself, right, to protect yourself from you, we're using this notional leverage number that tells us, right, 1.5 is kind of a middle for me. Anything around 3 is kind of already that's very, I mean, that's aggressive, right? Can we go 3.5? Yes. I think I was as high as 3.8 or something like that. But you just want to know where you stand with this. And look, this trade can work for long periods of time. It's very slow. And given how little management it takes, you can literally do this trade. If this is all you do, it'll probably take you, I don't know, 15 minutes a day. And if you can make 18% or even 15% return on your overall account trading 15 minutes a day, there are plenty of gurus they're selling this kind of crap on the internet right now. All right, so that's SPY. Another variation of SPY, which is these have to be cash secured. So I'm not even sure if cash secured makes sense and then take an assignment makes sense. I would rather, instead of committing settled cash to holding shares and then selling covered calls, I would rather deal with in the money puts. So this kind of evolves into this strategy that I'm doing right now. I'm selling an out of the money naked put. I'm trying to collect. I started with about $5. I've moved recently to as high as 7 and change, but I'm 670s. If we look at an average credit is 558, so maybe around $6 or something like that. We could also see that here, this will tell us an average credit is 558. It's probably going to get closer to 6. So if I can sell a put for $6, I don't look at the delta. I just look for a dollar amount. If I could sell a put for 6, get out for 50% or as close to 50% profit as target as possible. So I'll make $300 a pop. You can see my average winner right now is 273 per one contract. Maybe that's going to get closer to around $300 when my average credit gets to about $600. Right, and I'll stay with this trade. I'll keep track of return on, you can look at return on risk, return on margin, return on whatever. But I think, if you want to be conservative, just look at return on overall account. That number is going to be way lower, but it's going to be a little bit more stable because margin, even though it takes very little to put this trade on, when the market starts to roll over and volatility starts to pick up, your margin requirements are also going to go way up. So you will need to adjust those numbers as well. Let's see what else. Spreadsheet is I shared a. I'm not sure if it's a copy. I think I shared a template because my data. I mean, if you want to look at it, that's fine. I have no problem with that. But You want to keep track of your data, and based on your outcome, you want to decide how to adjust your trades going forward. Maybe $6 credit is not enough. Maybe you want to go for $10 credits and adjust your profit targets instead of 50%. Maybe you're trying to grab first 30%. Still going to make $300 a pop, right? If you put on the trade for a $10 credit and you're targeting 30% of those $10, you're still going to make $300, except you're not waiting for 50% of max profit. You're only waiting for 30%. So maybe, right, if my average days in the trade here to get to 50% is 20 days, if you target the first 30% instead of 50%, maybe your average days in the trade will be, I don't know, 14 days, right? So you'll shave 6 days off, which means you'll have a higher turn on your capital, right? You'll probably have maybe higher turnover. So maybe you'll be able to generate a little bit more yield in the account. The only one thing I can see off the top of my head here is that if you're trading or if you're selling puts for $10, your notional value is going to be much higher. And if you are using some reasonable notional leverage multiple, you're probably not going to have as many tranches on. So I think both trades will be fairly equal in terms of return on capital.